Thanks for plugging in to Rethinking the Dollar. I'm excited to have my guest, Jordan Roy-Byrne from TheDailyGold.com, sit down with us to discuss his book, The Coming Renewal of Gold's Secular Bull Market, and also to give his take on the economy. I'm sure you enjoyed this interview. Also, click the subscribe button below for more interviews as well as monetary news updates in the future. Enjoy.
Welcome to Rethinking the Dollar. Today I'm excited to have my guest, Mr. Jordan Roy-Byrne from TheDailyGold.com. He's a chartered market technician as well as a member of the Market Technicians Association. He's the publisher and editor of The Daily Gold Premium, a publication which emphasizes market timing and stocks selection for a sophisticated investor. And George's work has been featured on CNBC, Barrons, Financial Times Alphaville, Kitco, and Yahoo Finance as well. He's also the author of the book we're going to discuss today, The Coming Market of Gold's Secular Bull Market, Dump U.S. Stocks and Prepare for the Gold's Final Run. So Jordan, welcome to Rethinking the Dollar.
Mike, thank you so much for having me. I appreciate the opportunity to speak with you today.
Yeah, definitely. And that title itself, it has a lot of meaning within it itself alone. And so when I saw the Dump U.S. Stocks, I'm like, whoa, what is this? This is some serious stuff here. So I'm glad to have you on and looking forward to diving into your book and getting a more in-depth look to your work and going from there. So with that being the case, just to get a little bit of information about yourself, how did you get involved in the precious metal sector as well as the market technician sector? How did that come about for you?
Well, when I was younger, I was always very interested in investing and making money, and I started following the stock market mid-90s, late 90s, and of course, technology was in a raging bull market that turned into a bubble, and I got in early enough where I didn't get hurt by the bubble. The problem was after the bubble collapsed, I was so naive that I didn't know that it was over with, and I was still buying stocks in 2001 when they had already gone down, thinking they were great values. And then a year later, I realized it was over, but by 2002 things were starting to turn around. And then some people were telling me about precious metals and gold, and I want to say by 2003 I pretty much became convinced, I should say, that we're in a huge new bull market for the resource sector. And so I was more into energy, but I always had gold and silver in the back of my mind as something that would do really well. But energy was more easy to get into at the time because the companies were making money, whereas because in the oil and energy sector, most companies, it doesn't take them like 5+ years or 10 years to discover something and then get into production. That's the big difference when you're looking at the metals. For a company that's just starting out, even if they're successful, it can be 10, 15 years before they start producing that metal and making money. So that's what forced, I should say, really put me into energy first. But then 2004, I became convinced that gold was really going to be the next big thing. And so I kind of got lucky there. I was waiting, and then I kind of went all in on gold in 2005, and I got lucky because it did really well for the next couple of years. And so that's kind of how I got into the sector, was really from an investment standpoint. And I still believe that the major trend that started in gold and also resources around the turn of the century, I still think that has years to run and that we haven't seen the end of it, as a lot of people think that 2011 marked the end of it. So that's what got me into precious metals, was really from an investment standpoint. But some of the issues that we're going to talk about today, I certainly I can speak on those. And gold bugs do kind of get a bad rep sometimes because they can be too extreme in their views. But I do, even though I'm into precious metals for mostly investment purposes, I would call myself a gold bug, and I do believe in a lot of the things that they believe in, and I do believe that gold is important, and it's important to understand the monetary system and all these things that we're going to talk about here.
Right, understandable. Now, your book, I'm assuming as you got more involved into gold, became a gold bug, you created the Daily Gold, and so your book, how did you get into the idea of putting it all together in your research? Because I noticed that throughout the book, there's a lot of detailed graphs and correlations between the equities market as well as the commodities market, and so you did a lot of research with that. How did that come about, and why did you feel that putting together the book as extensive as it is with all that research was important at this point in time?
Well, there's some great questions in there. I put it together because after gold collapsed in 2013, when late 2012, gold came down from about 1800 down to 1550 or so. Then it kind of bounced back. Also, secondly, just because I know we might get into this, but I think there's a big misunderstanding of what really drives gold as an investment. So obviously a lot of people who are anti-gold, they don't really understand it. But there's a lot of people who are pro-gold, and they say, well, gold's going to go up because of this reason or that reason. And I mean, a lot of that, in my opinion, is not correct. So I just think there's a lot of bad information on gold out there. And that's not to say that Jordan Roy-Byrne, have every answer and all the information, but I put out the book because, look, here's some facts you can rely on. Here's my opinion, and these are derived from facts and data that go back 100 years. So that's really why I wanted to write the book. Those two reasons. Now, what was your last question in there?
No, the goal was just to get more in-depth information as to how it all came together for you. So you did a pretty much good job of covering that. Now, as far as the book itself, I'm assuming it's due to the fact that there's a lot of things going on outside of the precious metals market and things like that, and the equities market. And so our national debt. I want to get into that real briefly before we dive into the nuts and bolts of your book. And how important is it for people to understand our national debt as far as the value of their money? And how do real rates and real yield factor into the value of fiat currencies? So those two questions there. Yeah.
Well, first with the national debt, when countries become way too indebted, it can usually lead to a currency crisis, and usually the end game is huge inflation down the road. Now, for very small countries, it can be hyperinflation, so it can be really scary. So not as scary for a big country like ours. But that's really the issue. And the problem is not so much the debt. The problem is when the debt becomes so big that number one, it affects the ability of the country to really grow. And secondly, because the country has to be able to grow its way out of the debt. I mean, we're not going to pay back 15 trillion or whatever it is. The way you get out of it,
18
as
plus
what happened in the 1940s, is you have to grow your way out of it, and inflation also helps you do that. So that's what you have to understand about huge debts, is that down the road it can lead to big inflation. And also when the debts are so huge, it prevents, because if the government is paying too much of its budget just on interest expense, that's money that it can't use to perhaps do a big tax cut and give back to the people, or it's money that it can't invest in infrastructure building or whatever. So I mean, those are the reasons why what people really need to understand about the national debt.
Now we're at 0% interest rates, and basically the yield upon a lot of investments is non-existent. And so how has all the national debt factored into the fact that we're in a zero interest rate environment now, and no one's making money upon their money or investments?
Well, I mean, that's a great question. I want to touch on, I think, what you said before, but I forgot to speak on the real yields and real rates.
Yeah.
I mean, I know we'll talk about how that affects gold, but when a government gets in a huge debt crisis, they need inflation to get their way out of it. And the way you get inflation is by you have negative real yields and real rates. And so what that means is, real rates, that's the Fed funds rate, and real yields we're looking at, I mean, it applies to any bond or income instrument, but really we're looking at the 2-year bond or the 5-year bond. And so if inflation is 3%, but you can only earn 1% or 2% if you're putting your money in the bank or one of these instruments, your real return, inflation adjusted, is negative. So you're not earning anything on that money. And so that's the problem with when you have 0% rates, or when real yields are negative, is it forces money into the economy unnaturally. I mean, it forces a lot of speculation, and that's why we see a lot of money. I mean, first, after the financial crisis, the money went into hard assets. Now it's going into junk bonds, it's going into the stock market. But governments have to have negative real rates and negative real yields to create inflation, which helps governments get out of a debt crisis. I mean, that's what happened in the 1940s. After World War II, we had negative real rates and negative real yields. It was very volatile for a period of about 10 years, from 1942 to 1951. But I mean, I think we had rates at 2%. I mean, there was one year when inflation spiked to 20%. But that is what has to happen for a government to really get out of the debt crisis. You need to grow your way out of it, and you need inflation to go with that. Because when you get inflation, it reduces the real value of the debt. I mean, if you own or if you owe, you have a mortgage for $200,000 and you can't pay it, well, in the next couple of years, if the value of the money goes down by 50%, and then that debt that you have, the real value of it is then much lower, and it's much easier for you to pay it because of that inflation. Right. Just to give a little explanation there. So that's really why real yields and real rates are important. They want to keep them very low, and then in real terms negative, because it forces money into the economy, and they hope it's going to create inflation, which will kind of, as I said, it will reduce the real value of these debts, and eventually, help the economy get out of this. But of course, like I've been saying, the big problem is, and the big risk in the years ahead, which I know we'll talk about, is inflation can rise. And I mean, I know some people say, we're going to have hyperinflation, or the dollar is going to become completely worthless. I don't see that happening. But I mean, what if we have inflation that's 10% a year for a couple of years, or 15% a year for a couple of years, and then it goes to 7% a year? I mean, that is still a huge problem, where the cost of living can really accelerate just over a couple of years or over 5 years. And so that's the big problem and the big risk that the average person needs to understand, which could happen in the years ahead.
Right, and I know, if I'm not mistaken, that in the 70s, inflation rate was fairly high, and the cost of living was pretty much changed for everyone. But yet, being in a different economy, and it was, the cost of living wasn't that expensive technically as it is now. I'm assuming it wasn't that much of a big factor for my parents or grandparents, things like that. So definitely now, being that everything is already expensive, inflation, and if it was to become a much more problem than what it is, that I can imagine it being very, very uncomfortable for a lot of people, such as it is in out of the country, such as Venezuela, Argentina, things like that. And so let's get into your book now, The Coming Market of Gold, Secular Bull Market. In the first part of your book, you mentioned that gold is misunderstood, and many fans and detractors, have opposing views. What did you mean by that statement there?
Well, I mean, immediately when it comes to gold, a lot of people think the 1970s, gold's an inflation hedge. And then it also performed well around 2008, where there was deflation fear. So some people think it's a deflation hedge. But when you just look at what a lot of the people who don't like gold as an investment and kind of view it as a nuisance, they don't really understand what gold is. Gold's a currency, and why it performs well. And the same thing with a lot of bulls. I mean, we have a lot of gold bugs. Gold hasn't performed that well the last couple of years, so they're kind of searching for outside reasons as to what's going to make gold go up. And a lot of people are talking about, well, China's buying tons of gold, and therefore gold's going to go really high. Well, China has bought tons of gold in the last couple of years, but the price did not go up.
Right.
So if you go back and you study history, what really drives gold is negative real yields and negative real rates, which we spoke on, because if you put your money in the bank and you're only earning 1% and inflation is 2%, 3%, or 4%, gold is going to do really well in that environment, because you're not earning a real return. You're losing money in real terms. And gold, you invest in gold, you don't get any yield. So gold does well when real yields and real rates are negative. And 3 or 4 years ago, gold was doing really well in U.S. dollars in every currency, because real yields and real rates were negative. But what's happened in the last 3 or 4 years is, if you look at it in the U.S. now, the real Fed funds rate, which was 3 or 4 years ago, was -4% or -3%. Right. It's now around 0 or maybe slightly positive. So that explains fundamentally why gold has come off so much. but gold has been much stronger if you price gold in foreign currencies like the euro and the yen, especially last winter. We saw huge moves in gold pricing in those currencies. And the reason for that is because their rates and their yields went really, really low. So even though the rate of inflation appears low, if you had your money in Japan or in Europe, you were losing money. I mean, even though inflation was 0% or whatever it was, their yields actually went negative. So the price of gold in those currencies did really well at the time, but it wasn't doing as well in the U.S. dollar because the real return on the dollar, it didn't drop and become negative again like it did in Europe and Japan. So it really all comes down to real yields and real rates. It's the major driving. I'm not saying it's the only driving force, but it's really the major driving force for gold. And because when the real return on these, on a savings account or a 2-year or 5-year bond, when that is negative, the real big money in the Western world, I mean, fund managers who manage millions and billions, I mean, when they see that, they invest in gold. And so that's where the investment demand is, which is the real driver. The investment demand is the real driver, and it follows real yields and real rates. And so, I mean, a lot of other people will talk about, well, there's great physical demand for gold. Physical demand for gold from 1980 to 2000 went up a lot, and the price of gold went down. So gold demand, generally speaking, is always going up. And in addition to that, people talk about how China's bought tons of gold and China wants the gold price to be really high, and there's huge physical demand. I mean, that may be true, but it really comes back to real yields and real rates, because as I was saying, the real big money in the Western world, I mean, we're talking about millions, hundreds of millions of dollars, it goes into gold when they see that real yields and real rates are negative.
Mm-hmm.
And that just amount of money and demand from the Western world completely overwhelms all these other things that a lot of gold bugs talk about. So, I mean, if you understand real yields and real rates, then you'll really understand, what will move the price of gold in either direction.
All right. Now, in your book, you do a good job of showing a lot of charts that reference the correlation between precious metals and the U.S. equities. As far as I look on your site now, you have I think the GDX and things like that. Things I'm not too familiar with. How has over time the introductory of the equities market, as far as the ETFs and things like that, with the gold pricing, how is that all factor in now to the real value dealing with the yields and things like that?
You're talking about the ETF,
correct?
GLD,
yeah. Like the pricing of that with the actual physical supply and things like that. Some of the driving forces behind gold's valueness.
Well, GLD, the ETF, that made it a lot easier for people to buy gold.
Mm-hmm.
But the negative of that is it also made it easier for people to sell gold. So a lot of that Western-based demand that I was talking about, that went into GLD, and we've seen that coming out the last couple of years as a lot of those people, they saw gold break below 1,500, or they thought it was going to break below, so they started selling gold, and that came in the form of a lot of money coming out of the GLD. So it certainly made it easier for people to buy gold, but also sell gold.
Mm-hmm.
So, the introduction of that ETF, that's been the effect of the introduction of GLD and other ETFs like it.
Yeah. Now, the subtitle of your book, Dump U.S. Stocks and Prepare for Gold's Final Run. Let's get into that a little bit. So as part of your, investment strategy, or how do you dump U.S. stocks and just really ride the bull run in gold that you're referring to?
Well, the dump U.S. stocks, I know it's kind of a strong message,
yeah.
But you have to get people's attention up front, or they won't really pay attention,
yeah.
Or give you or your work any attention. The book is mostly about gold, so I hope to attract some people, maybe the average person who's trying to make sense of what's going on. I mean, they saw the financial crisis, they saw gold go up a lot, but then gold went down. I mean, the S&P 500 went down 55%, and then after that, it's gone up for 6 years in a row. And so, I mean, in the book, I'm really trying to, help the average person make sense of, what's happening, but more so with respect to precious metals. But I also point out, I mean, in the chapter about U.S. equities, I mean, they've obviously had a great run, but a lot of people are now thinking, well, we're in this new environment. I mean, the worst is over, and this is like the 1980s where gold is done and stocks are going to go up for another 10 or 15 years. If you look at, I mean, if you kind of compare what was happening then and what's happening now, just with respect to valuations and sentiment measures, I mean, how many people own U.S. stocks? All these things are really flashing red warning signs. And, nobody can predict the future. We don't know what's going to happen with the stock market in the next year or two, or even the next 5 years. And so valuations do a really good job of projecting what the returns for a market are going to be over the next 10 years. It's over a long period. Like, for example, right now, some really, really cheap markets are Greece and Russia. And if you look at valuations of those markets, 10 years from now, you're probably going to make a lot of money if you invest in those markets. But that doesn't necessarily mean you're going to make tons of money in the next year or two. I mean, they could be up 50% in the next year. They could be down 20%. But just looking at how cheap something is, it generally means that 5 or 10 years into the future, the chance to earn returns on that market are very good. Now, a lot of the valuation indicators for U.S. stocks, they're just really, really close to all-time highs. And, I mean, that's really worrisome. They're close to 1999 to 2000 when, I mean, that was a huge bubble in the tech sector, but valuations were very, very high. I mean, almost at all-time highs at that point for most things you look at. And so now a lot of valuation indicators for U.S. stocks are approaching those levels. Yeah. So, I mean, that tells you that the long-term outlook over the next 10 years, probably 5 years, is not very good. I mean, that just tells you that returns over that period of time are likely to not be very good. Now, Mike, the same thing was the case if you bought stocks in the year 2000 or if you bought stocks in the year 2006 or 2007. It doesn't mean you can't make money, but it means that you really have to buy at a point when these markets are cheap in terms of their valuations. When something is really expensive, that means its future returns from that point are likely to be poor. Now, 2 or 3 years from now, if the U.S. stocks are down 25 or 30%, odds are the long-term projections for future returns, if you buy at that point, are going to be much, much better than if you bought right now, for example. So that's what people need to understand. Right. And it goes back to the correlation, the long-term correlation between gold and U.S. stocks. It's negative over, we're looking at 15 to 20-year periods. That correlation is negative. Now, of course, we've had this huge shift since 2011, so some people are probably thinking, we're in a new long cycle where gold's going to do poorly and U.S. stocks are going to do really well. I don't quite see it that way, but of course, people have to read the book, look at my information, make their own conclusions.
Right. Fair enough. Now, as we wind down towards the end of our conversation here, I wanted to get into some of the geopolitical events going on. And typically, I start off asking about rethinking the dollar concepts. And so, because my goal with this whole interview here is basically inform the uninformed on monetary issues, dealing with monetary usage behind precious metals such as gold, which is your expertise, and the equities market, which you're very familiar with. And so, what comes to mind when you think of the words rethinking the dollar? Like, about all the things going on surrounding metals when it comes to the fiat currency known as the United States dollar or the Federal Reserve note. What are your thoughts and opinions as to what it is now and what it might be as we head into an uncertain future?
Well, I mean, what it is now, it's really gold is a backstop to the entire system. But of course, gold and the dollar aren't really connected. But at the same time, countries they keep their reserves in gold. If you look at the U.S. and other Western nations, they have most of their reserves in gold. I mean, there's a reason for that. It's a backstop. And so, but as far as rethinking the dollar, I mean, I just think that we need to understand really the importance of having a strong currency. And you go back to 1971 and when we went off the gold standard, a lot of problems have started at that point and really accelerated. I mean, being on this fiat currency system, it's really caused the huge division between the rich and the poor. And it's not even, I mean, a lot of people, they say, well, if you're making over $300,000, you're rich. But what we've seen in the last 5-10 years is there's even if you look at the top 1% versus the top 99%, I mean, it's really not the top 1%. It's like the top 0.1%. Because the top 1%, I don't know what that is. You're making $400,000 a year or something like that. You're in the top 1%. But it's really the people who are making 10, 20, $50 million a year. I mean, this system is, I mean, yes, it's hurting the middle class. It's, it's causing a division between the rich and poor. But I mean, it's also causing a division between the rich and the super rich, because people who were rich 10 or 20 years ago, I mean, now they're less rich, and they're kind of fading more to the middle class. And the people who are really rich, I mean, they're just getting filthy rich on top of that. So, I mean, it's not natural that people are making 50 or 70 million dollars a year. I mean, it's just, it's great for people to make lots of money and be rich, but it's just what we're seeing now, the division between the rich and the poor, and then the rich and the super rich. Yeah. And it's not natural. It's not sustainable. It's a product of this system. And when you have this currency depreciation and you're on this type of system that we've been on, it hurts the average person. It hurts the people at the bottom. And that's why the middle class has been hollowed out. I mean, it's really sad. And a lot of people and politicians, they don't focus on this. I mean, they think, well, every person has to go to college and every person should make $100,000 a year, but it's not. That's just not the way society works. Right. The way to protect, people who work at McDonald's, people who are wage workers, I mean, the way to protect them is protecting the value of the dollar and having a strong currency. And that was the case, until 1971, and we went off the gold standard. And I'm not saying that going back to the gold standard is the answer. I mean, I don't know what the answer really is. It's probably a combination of things. But I mean, if you go back to 1800 and then compare it to 1900, look, there were a lot of terrible things that happened. There was a lot of economic volatility in between those times. But look, the inflation from 1800 to 1900, I mean, the value of money held very strong during that period. And as a result, millions of people were really lifted out of poverty and into the middle class. And so the value of the currency, it has to be protected if you really want to protect the middle class and the other people, the other vulnerable people in society. And look, on this new system that we've been, I mean, this fiat system since 1971, it's causing, as I said before, I mean, it's causing a division between the rich and the poor, but also the super rich and the rich. Right. So, and I mean, these things are not sustainable. I mean, whether it all blows up in 3 years from now or 13 years, I mean, I don't know, but it's unsustainable, and we're going to see major changes in our lifetime for sure.
Right. I've never heard of the idea of a division between the rich and the super rich. Like that right there is a new concept to me, because it's always been the middle class and the rich, but now it's the super rich versus the rich that are probably going to have some outings pretty soon now, especially with that whole art fiasco of all the expensive art selling at all-time highs. And I saw some of those pictures of portraits rather, and they were just not of my taste. Not that I'm in an art field, but yet nothing I would want to spend buku billions or millions rather worth of dollars on. So just shows the times we're in where art is going for extremely high prices nowadays between the rich and the super rich. So Jordan, I thank you for joining us here on Rethinking the Dollar. Give the audience a way to get connected with you and to learn more from you, what you're doing, as well as to get a copy of your book, and give us some details on how to stay in tune with what you're doing.
Oh, thanks so much, Mike, for having me on. People can follow me at TheDailyGold.com, or they can follow my work, I should say. If they have any direct comments or questions, they can email me, Jordan at TheDailyGold.com. And I look forward to TheDailyGold.com. The best way to follow my work is follow my website, TheDailyGold.com. If people are more into the investment side and want to know my thoughts on how markets are moving, I have a premium service, but they should sign up for my free newsletter. There's some sign-up boxes on my website, and so every weekend I provide some thoughts there, and so that's a good way to follow my work directly.
Well, thank you. I appreciate you taking time to speak with us here. Definitely learned a lot myself. And other than that, I appreciate you joining us. Look forward to speaking with you in the future.
Mike, thank you so much for having me. It was a real pleasure.
This concludes my discussion with Jordan from TheDailyGold.com. Hope you found our discussion to be very entertaining. I want to encourage you to get a copy of his book, The Coming Renewal of Gold's Secular Bull Market. Also, scroll down below, leave us a comment. We'd love to hear your thoughts. And also, click the share button to share this information with others that might find it informative as well. Also, visit Rethinking the Dollar for more educational tools. I'll see you soon.